Hey everyone, how you doing? As most of all of you know, but for those of you who are new to the firm or haven't met me, my name is Dr. Jason Van Duyn, and I'm excited to talk about some things today. So we're getting so many questions and comments lately about the market and the economy and what's going on. So what we did is we decided to do this presentation based on the information that we have from the first half of the year. And what we're going to do is we're going to kind of take that and we're going to try and add some context to it by looking at past either expansions or contractions, and just to try to gain some insight on what we might be able to expect here over the next 3 to 6 months. So what we're going to do is we are going to look in the context of a couple different things. But as Gary had mentioned, you know, if you guys, everyone who's muted, I think is great. Feel free to turn on or off your cameras, whatever you're most comfortable with. And then we'll take questions at the end. Also, a lot of people don't like to ask questions in a public forum. Even though, trust me, probably everyone else has the question that you have. So feel free to reach out to whichever request advisor that you work with, you know, or either by phone or email, and we'd be happy to answer anything that we can for you. So, you know, like I said, we're going to kind of look at things in the, you know, what's going on in the economy in the context of a few different things. So and basically, I'd say the market's way up, right? We all know that. It's been great for everyone. But what sort of headwinds do we have? What are those, and are they going to derail the economy and the stock market or not? And if so, what should we be looking for? And so the things that we're going to look at as headwinds are things like the government. You know, are they going to kill the market with taxes? Are they going to kill the market with a fumbled stimulus kind of pullback? Is the stock market just so high it's going to come down just because it's so high? What's going on with bonds? Is inflation going to derail us? So we're look at all of those things and basically, are they serious, or do we really think they're going to derail us, or is it something that is manageable and we think that they may not derail us? So and we're going to look at that in the context of a couple of different things. The first one is just the economy and kind of what is going on with it. So the economy has been better than I had expected, quite frankly, through the first half of the year, and better than most people that I talk to. And what I would say is, I would think that the growth rate in the economy has probably peaked, and that probably happened in the second quarter. That doesn't mean I don't think that everything's going to contract and we're going into a recession anytime soon. But what I do think it means is that growth is going to be decelerating. So I think we're going to have slower growth probably the rest of this year as well as the beginning of next year than we've had. The question is that slow growth going to turn into something negative, to where you know, it is detracting from your returns, or is it just going to be growth but a little slower than what we've had? And if you look here, I find this a little bit confusing, but a good stat. So 2021 up until you can see down here 6/28 of 21. So up until 6/28/21, the growth in the U.S. had been really good. You know, 3.9% is crazy. Just to give that some context, the GDP last year, which I think most people on this call, and actually how I feel a little bit as well. I mean, I know the real numbers, but it's not how they don't reflect my feelings or my experience as an advisor nor as an investor. So last year, you know, most of us experienced COVID, right? A huge downturn, 40% in 40 days, but then it rebounded very quickly. And as far as our portfolios and the statements that we look at, or when you go through our website on Account View, you know, your investments started to look a lot better. But what that kind of masks is this number, this negative 3.5. Negative 3.5% is not stock market growth. It's actually GDP, gross domestic product. So it is the total goods and services produced in the United States contracted by 3.5%. You might think, well, you know, that's not really that much. That's pretty reasonable. And it might not sound like much, but it's the largest drop since the Great Depression, not the Great Recession we had in 2008, the Great Depression, you know, that we had in the 30s. So it was a big contraction year. Again, I don't think most people, at least that were able to maintain their job or their business, I don't think most people necessarily felt that because of government stimulus and because the stock market rebounded so quickly. But last year was the worst year for GDP in 80 years since the Great, well, you know, almost 100 years since the Great Depression. That's a big deal. That has come back a lot, as you can see, by 3.9. But what LPL's analysts are estimating for the full year growth is only about 6.5. So you can see if you multiply 3.9 times 2, you get way more than 6.5. That's because they think growth is going to decelerate. So they think we're going to get about 4% growth in the first 6 months, but only about, annualized, and only about, 2 to 2.5% annualized growth in the second half. So we expect growth to slow down almost in half, in the second half of the year. And this is almost October, so we've already seen that happening a little bit in the third quarter. You could there look at other, emerging markets developed in global average. So what I think is interesting is this number here. It shows that developed economies, basically Japan, Australia, and Europe, are not doing as well as we are. So they had a worse contraction. And again, 0.4% might not sound like a lot, but it's like $100 billion, right, of goods. I mean, it's a lot. So they had a worse contraction, and they've had a worse recovery. And quite frankly, it's the exact same thing that happened in 2008. They did poorly in 2008, and really a lot of the world has not really come out of it, even until COVID hit. They did austerity where we kind of spent our way out of the problem. They tried to cut their way out of the problem through reduced spending, and that did not work. Britain, and most of Europe went through basically a triple dip recession over a 10-year period of time, where we came out of it and grew a lot. So what I would say is that GDP is going great. That's good. The whole economy is growing. That's helping, of course, spending and the stock market gains. So let's talk a little bit about that. So since World War II, you can see right here, this 5.3 years, the average expansion in the economy has lasted about 5.3 years. Now, why I think this slide is interesting and why I chose to talk about it is people that I talk to tend to fall into two camps. Camp number one says, Jason, yes, the longest expansion in history, right here, from July of 2009 until spring of 2000, had gone on for 10.7 years. It was the longest expansion in the history of the United States of America, right? And then COVID happened, and it was only for a couple months, and then we've come out of it. Technically, that began a new, cycle, right, or a new expansion. So the pessimistic people, and I don't mean that negatively, it's just that they pessimistic in the sense, they tend to say, well, Jason, we're not going to get a 5.3-year expansion this time around because this is basically just a continuation of the 2009 expansion. We just had that little COVID blip. It didn't last very long. And now so it's a continuation. So if we get another 5 or 6 years of expansion, that's going to be like a 15 or 16-year expansion going all the way back till July of 2009. And that's probably not going to happen, especially with all of the headwinds, that we're facing, inflation and potentially rising interest rates and, supply chain issues and so on and so forth. There's a whole other camp of people, and I'd say most analysts and economists probably fall into this camp, that say, no, that, COVID ended that expansion, 10.7 years, that's it. Now we have a whole new expansion, and that expansion is being fueled heavily by government stimulus and super low interest rates. And that could potentially last 5.3 years or even longer. So again, it kind of depends on what camp that you're in, but I think either way, this slide is probably pretty supportive of at least a decent next couple of years. It might not get to the 5.3 average, but at least it'll be okay for the next couple of years because we have this new expansion happening. And again, we'll look at the 4 things that I think might be able to stop that, at a year or two, instead of having it last all 5.3.